In this video, I'm going to show you guys the best smart money strategy, which is the unrefined version, and it is a 3-step process, and it's the most profitable strategy that I've used. Okay, so number 1 is break of structure, number 2 is POI, and number 3 is our entry schematic. And in this video, I'm going to run through all of them steps, cover them in depth for you guys, piece them all together, and then show you guys an in-depth trade review. But first off, I just want to start off with the basic concepts of the strategy. Okay, so in terms of raw market structure, what we want to see is a high in the market, followed by a higher low, followed by a higher high. Okay, once we see the higher high, we can mark on our break of structure. So we can mark this on as a BOS, a break of structure to the upside. Okay, once we've marked that on, we can also go ahead and mark on our guarded low. The guarded low is the invalidation level, and we do not want to see price close below here. That would indicate that this buy bias is no longer in control. The buyers are no longer in control. Okay, the impulsive leg that we are after and that we're interested in is this grey box here. So we're only interested in within this zone to look for long trades. Okay, in terms of market structure, so we have a high, a higher low, followed by a higher high. Okay, so number 1 is the break of structure. That's this leg here, which broke structure. Number 2 is our POI. That is our point of interest, and that is the only place that we are going to be looking for a long trade on this market. So we mark on our POI as a blue zone there. So if and only if price comes back to our POI, then we will look for a long trade. So once we've seen the higher high, we're looking for number 3. So we're looking for price to come back into our POI. From here, from this POI, we're looking for number 3, which is our entry schematic. If that lines up within this area, then we will look for a long trade out of here and then look to ride this trend back to the upside. In terms of our entry tool there, we're going to have a stop below the guarded low if possible. If not, it'll be below the rejection candle, and we're going to be targeting equal highs as a first TP, and then ultimately for more continuation to the upside. So we're entering around here, the range lows here out of our POI, which is our extreme demand, and we're then going to be looking at targeting this equal high here. So targeting this equal high and then looking for ultimately further continuation to the upside, running all of these stops here above the equal high for all of the sellers that decided to get in this market too early. Okay, so that's the entry schematic in a nutshell, and that's this is a buy bias based strategy in this example. So I'm going to run through this now step by step on the live markets, and this is a trade that presented itself a couple days ago. Okay, so let's move this over here. So number 1, actually let's move this here for simplicity. So number 1, we want to identify a strong break of structure to the upside. Okay, so let's play this market on. You can see clearly price impulsively breaks structure to the upside. We can mark this on as a BOS. Okay, so if you just picture the entry schematic we were looking at there, we've got a break of structure to the upside. We've broke strongly, indicated by these strong bullish candles. Clearly the buyers are in control of this market. Okay, once we've seen the break of structure to the upside, we can then go ahead and mark on our guarded low. Okay, so this is our invalidation level. Mark that on as a guarded low. So if price comes down and closes below here, closes below our guarded low, price closes below, that'll indicate to us that our buy bias is no longer valid within this market. Okay, so we're looking for price to come back into that area. We can mark on our structure here just for simplicity. So we have a high in the market, we have a higher low, followed by a higher high. Okay, the impulsive leg that we are looking at is this leg here. We're not bothered about any other price action or any other parts of the market. We're not bothered about any of the swing points down here. This is really where new traders can get very confused in the market. We're only bothered about the most recent price action, the most recent impulsive move. That's where the orders are going to be accumulating from the institutions. Okay, so we can mark on our POI number 2, and we can mark that on as a blue box there, POI. Okay, so we've marked on our break of structure, we've marked on our POI. Now we're looking for number 3, which is our entry schematic. If and only if price comes back to this area and rejects, then we can look to enter a long trade. One more thing to note is our POI is drawn on by the open of this candle down to the low. So the open of the most recent down candle before the up move. Okay, so this lines up with the low from the open down to the low. This is our extreme demand, and this is the only area where we're going to be looking at taking long trades. Okay, so now let's play this on and allow price to play out. Okay, so now that we can see price has retraced quite a bit, we know we've got an equal high target up here, up at the highs here. So if we're triggered in our trade, we're going to be targeting this equal high, and then we're going to be looking at further continuation. So we're looking for price to come back in here, and this is also where retail traders may get messed up in this market. So, you can see rejections in the market, but they're not out of the extreme demand, right? So, if you're a retail trader and you're entering long here with a stop anywhere, below these wicks or around here, you're just going to get run over. It's just going to run your stops to the downside more than likely, because at any point, any given time, price can come into our extreme demand. Okay, so if we play this on now, okay, let's play this back one more. So, if you had your stop below these wicks here, you would have been stopped out. Okay, so that's why it's important to only enter from rejections out of the POI. You can see price just comes into our POI and then rejects strongly. Okay, so once we see the strong rejection, you can go for a conservative stop just below, a few pips below the rejection candle, or if you want to be very conservative, you could have a stop loss below the guarded low. Okay, so my stop loss was just below the rejection candle there, and that is number 3, which is our entry schematic. So our entry schematic is a rejection, a nice strong rejection out of our POI. That's a trigger for us as traders to enter a long trade in this market, as long as all of the other confluences have been met. You can see first target up to the high is a 1 to 2.33 risk to reward, and then ultimately we're going to be looking for more continuation to the upside, targeting all of the sellers that tried to get in this market too early. Okay, so if you look at this from an institutional perspective, institutions entered the market here long. They entered long indicated by the strong bullish momentum. So when price comes back into this area where the institutions entered long, we're anticipating that the institutions that went long here, they're going to be looking to defend their buy positions and look for further continuation. Also, in order for institutions to move price like this, they need to sell strongly into the lows here. So in order to sell strongly, to create that liquidity in order to move the markets like this. strongly. Okay. So when price comes back into this area, institutions have a decision. Are they wanting to close these sell orders at break even and add to the existing buy orders that they have here? That, if they do so, will result in a strong bounce to the upside. Okay, so we're triggered in this trade, and now let's just allow price to play out there. Okay, so you can see pretty much within the next, so this is the 1 hour time frame, within the next few hours, TP1 was smashed at a 1 to 2.3, and then ultimately you're looking for some further continuation, and you can see the prices around a 1 to 5 risk to reward. And then if you allow this to play out, just to see what happens here. So you'd obviously be break even, and you can see here there was up to a 1 to 7.7 risk to reward available on this trade up at the highs here. So, you know, if you risk 2% on this trade, obviously nobody's going to be closing at the exact highs, don't get me wrong, but even if you closed at like 4 or 5 or, you know, this one trade, if you risked 2%, you had, you know, a chance to make around 10% on this trade. So this trade alone was more than enough to be able to pass a funded challenge in order to acquire funding capital. Okay, so that's just to illustrate the sheer power of this strategy. You don't need very many of these setups across the month, but what you do need is to choose the quality ones over the quantity, you know, and really stack the confluences in your favor there. So just to recap everything there, guys, we've got number 1, which is a break of structure. That is this here, the break of structure, so a strong break there. Number 2, our POI, our point of interest, that's this area here, the last down candle before the up move. And then number 3 is our entry schematic, which is the rejection, because this is the unrefined strategy here. Okay, so it's the rejection out of that area, and then that's our entry schematic, entry confirmation. Then we're triggering that trade, and then look to ride the trend. Okay, so guys, let me know your thoughts on this video in the comments below. Please like, comment, and subscribe, and I will see you guys in the next video. Take care, guys. Bye-bye.